Option contracts are one of the most powerful tools in a trader's arsenal, but they're also one of the most misunderstood. If you've ever heard terms like calls, puts, strike price, or expiration and felt overwhelmed, you're not alone. In this video, we're breaking down option contracts from the ground up, clearly, simply, and with no fluff. Whether you're investing in blue-chip stocks or looking for leverage in the crypto space, understanding options can give you an edge. We'll walk you through how options work, what makes them valuable, and how smart investors use them to manage risk or take on more of it. From the Greeks to volatility, from premiums to payoffs, we've got everything covered, all paced for clarity and structured for long-term learning. Stick around to the end for analyst insights on how options are reshaping modern investing strategies in 2025. Let's get into it. Chapter 1. What are options? At its core, an option is a derivative, a financial contract whose value is tied to an underlying asset like a stock, index, ETF, or even cryptocurrency. There are two basic types. Call options give you the right, but not the obligation, to buy an asset at a specific price by a specific date. Put options give you the right to sell. This concept isn't new. Options have been around since the 17th century, when Dutch merchants used them to speculate on tulip bulbs. Today, they're a standardized part of global financial markets, with trillions of dollars in volume each year. Options contracts are traded on regulated exchanges like the Chicago Board Options Exchange, CBOE, or via brokers like Robinhood, Interactive Brokers, or TD Direct. They are often used by hedge funds, institutions, and increasingly, retail investors. Each option contract typically controls 100 shares of the underlying stock, making them a leveraged instrument. This means your gains and losses can be much greater than in standard share trading. Options aren't just about speculation. They're also used for hedging, portfolio protection, income generation through selling covered calls, and sophisticated trading strategies like straddles and spreads. In short, options give you flexibility at a cost. Chapter 2. How options actually work. Let's break down what makes an option tick. Each option contract has a few key elements. Strike price, the price at which the underlying asset can be bought or sold. Expiration date, the date the option becomes worthless if not exercised. Premium, the cost of buying the option. The type, call or put. The buyer of a call option hopes the asset's price will rise above the strike price. They can then buy low, strike, and sell high, market. The buyer of a put option hopes the opposite. They want the price to fall below the strike so they can sell high and buy back low. Behind the scenes, option prices are shaped by several factors, especially implied volatility, time decay, and the famous Greeks. Delta measures how much the option moves in response to the stock. Theta tracks time decay. Options lose value as expiration nears. Vega measures sensitivity to volatility. Gamma deals with the rate of change in delta. These elements make options both powerful and risky. Options can be used in simple strategies, like buying a call on Tesla before earnings, or complex spreads with multiple legs. Retail-friendly platforms have made options more accessible than ever, but that doesn't make them safer. You must understand the mechanics. Utility-wise, options are a multi-tool. Traders use them to speculate, investors use them to protect, and institutions use them to shape entire portfolios. Price trends and long-term performance. Options don't have a traditional price history like stocks or tokens, but the volume and accessibility of options trading has exploded over the past decade. In 2010, options trading was mostly the domain of institutional traders, but by 2020, platforms like Robinhood and Webull introduced commission-free options trading, igniting massive retail participation. In 2023, the Options Clearing Corporation, OCC, reported over 10 billion contracts traded annually, a historic high. This rise coincided with volatile markets, inflation fears, meme stock mania, and an influx of millennial and Gen Z traders seeking leverage. While traditional investing emphasizes slow compounding, options offered fast, high-risk plays, and people took notice. In 2025, the trend continues. Brokerages have introduced AI-enhanced options strategies, real-time risk modeling, and easier access to multi-leg trades. And with crypto options growing through platforms like Deribit and Ribbon Finance, the line between traditional and decentralized finance is blurring. Options are no longer niche. They are now a core part of the modern trader's toolkit, with growing educational resources, analytical platforms, and regulatory clarity. supporting continued growth. Chapter 3. Analyst Takes and Investor Sentiment. Financial analysts remain divided on how the growing popularity of options impacts the broader market. Some see them as an important risk management tool. According to a 2024 J.P. Morgan derivatives report, institutions use options for hedging exposure to interest rate moves, geopolitical instability, and earnings volatility. They note that option flows often front-run directional moves in equities, giving sophisticated traders an informational edge. On the other hand, firms like Bank of America have warned about retail option speculation, especially in short-dated zero-day contracts, 0DTE. These ultra-short-term bets behave more like lottery tickets than informed positions, and they've been associated with increased volatility in tech-heavy indexes. Retail sentiment is equally mixed. A 2025 Charles Schwab survey shows that 48% of millennial investors use options regularly, most for short-term speculation, but nearly a quarter use covered calls and protective puts for income and downside risk management. This reflects a growing bifurcation of users, thrill seekers versus planners. YouTube finance influencers like the trading fraternity, Zip Trader, and Terry Igioma continue pushing educational content on options, and algorithmic signal tools are increasingly being marketed to new investors. Meanwhile, analysts from Morningstar and Fidelity stress that options are not inherently dangerous. The risk lies in misuse. With proper education and risk controls, they argue that options can serve as a sophisticated yet accessible strategy for retail investors seeking flexibility in a volatile macro environment. The sentiment is evolving. What was once a niche derivatives market is now mainstream, with new tools, transparency, and investor protections making it viable for cautious use. Chapter 4. The Risks and Red Flags. Options offer power, but that power comes with serious risks. The number one risk is total loss of premium. If your option expires worthless, which happens often, you lose your entire investment. This is especially common with out-of-the-money contracts that never reach their strike price. Then there's leverage. While controlling 100 shares with one contract is appealing, it also magnifies losses. A 10% drop in the underlying stock can wipe out 80–90% of your call option's value overnight. Time decay is another invisible danger. As expiration nears, options lose value faster, even if the stock price holds steady. New traders often underestimate this and overpay for premium. Volatility crush is yet another threat. If you buy an option during a period of high implied volatility and the market calms, your contract's value can collapse, even if you were right on direction. Finally, there's the psychological element. Options can create a casino-like environment, encouraging overtrading and risky bets with short-term focus. This is why even seasoned investors treat options with caution, using them for strategic purposes, not speculation. Education, position sizing, and risk control are non-negotiable. Chapter 5. Forward Outlook. The future of options trading is both exciting and complex. Retail adoption will likely continue, especially as brokers introduce AI-powered guidance tools, risk modeling dashboards, and education-first platforms. We're also seeing massive growth in options on ETFs and sector-specific derivatives, giving traders new ways to express views. At the institutional level, options will remain a pillar of hedging strategies, especially with geopolitical uncertainty, interest rate shifts, and tech sector volatility. Crypto derivatives are also rising fast. Platforms like Deribit and Aivo are building the infrastructure to bring the options model into DeFi, allowing permissionless hedging and speculative exposure across chains. But with this growth comes scrutiny. Regulators are watching closely, especially around zero-day contracts and gamified interfaces. We can expect tighter controls, more disclosures, and possibly licensing requirements for leveraged instruments. Still, the overall outlook is bright. Options are becoming simpler to access, safer to understand, and smarter to use. For the educated investor, they'll remain a valuable part of a diversified strategy, not just a speculative thrill. Thank you for watching this video. If you found this breakdown helpful, subscribe to the channel for more deep dives on trading tools, crypto assets, and financial strategies that matter in 2025 and beyond. Smart investing starts with understanding your tools. Stay sharp, stay educated, and level up your financial health.